Well, for the 10th time, the Federal Reserve raised interest rates. Short-term borrowing is up another 1/4%, 2 days after the forced sale of First Republic Bank. Here to talk more about what this interest rate increase means for us is Associate Professor of Economics at FAU, Dr. Will Luther. Dr. Luther, thank you so much for joining us this morning. I'm going to go ahead and dive in if that's okay. So when could we see the increase in these rates eventually stop?
Well, I think that that answer may be today. Chair Powell yesterday at the press conference said that the Fed hadn't made a decision to pause yet, but they did change the language in their post-meeting statement, whereas previously they said that they were anticipating future increases. Now they just explain the circumstances that would cause those future increases. That looks a lot like a pause decision. And indeed, if you look at the futures market, they're pricing in a pause. So maybe today.
Okay. So, I mean, the whole point, according to economists, is that it's going to help with inflation. As an economist, can you weigh in? Do you think it's helping?
Well, we have seen inflation come down over the last few months. It rebounded in January, but has come back down in February and March, and we'll get the April data soon. But so far, that looks promising. So fortunately, it does look like inflation is finally starting to come down after being too high or too long.
Can you talk a little bit about what the rate hikes, what they mean for average Americans like you and me?
Well, it's tempting for regular folks like us to see those rates going up and think that it's necessarily bad. But it's helpful if we think about a big problem that the economy is facing right now. If someone is offered a job in another area, they're probably going to be pretty reluctant to move right now because it's very likely that their existing mortgage rate is lower than the rate they would be able to get in the market right now. So that reduces mobility in the economy a lot. It makes labor markets less effective, and ultimately it means that the economy doesn't grow as fast as it otherwise would. If we get that inflation under control, then the Fed can start bringing those interest rates back down, and then mobility will improve and economic growth will improve as well.
And really quickly, the U.S. could default on its loans in less than a month. What could happen if the economy and if Congress doesn't act? What happens to all of us?
Well, that would be a very bad situation. Bond holders have very long memories. So if the U.S. were to default on its debt, then those bondholders would require a premium well into the future. That means that the borrowing cost of the U.S. government would go up. And so regular Americans, we would either have to pay higher taxes to keep our existing level of services or be satisfied with a lower level of government services. So we would like to avoid that if at all possible.
Lasting repercussions for sure. All right, we're going to keep our eyes on all the announcements. Thank you so much for joining us. Really appreciate your insight into this. Of course, we have everything.